All right, so the Reserve Bank of India just dropped its latest monetary policy announcement. Now, if you've got a loan, any investments, or maybe you run a business, you're going to want to pay close attention. This stuff directly affects you. So let's break down what the RBI's latest move means for the economy and, more importantly, for your money. To really get what the RBI is up to, you got to ask, what's the big picture here? What's the master plan for the Indian economy? As we're about to see, the central bank's latest decision, well, it gives us some pretty big clues. And believe it or not, so much of it boils down to this single number, 5.25%. This figure is the absolute cornerstone of the RBI's current policy, and you can bet that markets and businesses have been watching it like a hawk. Yep, that's the one, the repo rate. The RBI's Monetary Policy Committee, they're the ones who make these huge calls. They've decided to hit the pause button. They're keeping the key policy rate exactly where it is, at 5.25%. Now, after a whole series of cuts, this is a really big deal. It signals a major shift in the game plan. Okay, so just a super quick refresher here. The repo rate is basically the interest rate the RBI charges to lend money to other banks. Think of it as the master interest rate for the whole country. When it goes down, your loans tend to get cheaper. When it goes up, not so much. It's their number one tool for steering the economy. So why pump the brakes now? Well, this decision wasn't just made out of thin air. It's because, frankly, the Indian economy has been getting a pretty glowing report card. Let's dig into the numbers that gave the RBI the confidence to take its foot off the gas. First up, growth. We're talking about GDP growth that has absolutely smashed expectations. India is on track to grow at over 7% this fiscal year. That kind of powerhouse performance is a huge reason the central bank feels confident right now. And get this isn't just a domestic win. That 7+% growth means India keeps its title, its championship belt, as the world's fastest growing major economy. And that's happening even while the rest of the world is facing some serious headwinds. But hey, growth is only one side of the coin, right? The other major factor is inflation. And on that front, the news is looking pretty sweet. The RBI is forecasting a nice, tame inflation rate of just 2.1% for the 2025-26 fiscal year, which is right in their comfort zone. This quote from the committee's official statement just sums it all up perfectly. You've got strong growth on one side and you've got inflation under control on the other. So their conclusion was simple. The current rate is, in their words, appropriate. It's basically the official way of saying, if it ain't broke, don't fix it. So what this pause really signals is a shift to a deliberate wait and watch approach. The RBI is kind of taking a step back. They want to see how their previous moves play out and just monitor how things unfold from here. Let's break down why they're being so cautious. Looking at this, you can really see all the different pieces of the puzzle they're juggling. On one hand, you've got great stuff like people spending money and stable inflation. But they're also being careful. See, they've already cut rates before, and they want to see the full impact of those cuts trickle through the whole economy. That hasn't fully happened yet. Throw in some global risks and the fact that new economic data is on the way, and you can see exactly why they've chosen to just wait and watch. Okay, so that's the high-level why, but let's get down to the nitty-gritty, the question you're probably asking, what on earth does this mean for your investments? Because the impact is definitely not the same across the board. Let's break it down sector by sector. First up, let's talk real estate. Because while the main interest rate didn't budge, the RBI actually slipped in a little regulatory change that is a huge positive for the sector. We're talking specifically about real estate investment trusts, or REITs. Now, Shishir Baijal from Knight Frank India nails it here. I know that sounds a bit technical, but what it means in plain English is that the RBI just opened up a massive new pipeline of money for real estate. By letting banks lend directly to these investment trusts, they've created a whole new way to fund projects. This is a structural game changer. Okay, so that was the good news. Now let's flip over to the bond market, where the story is, well, it's a little different. The vibe here is less about new opportunities and more about getting used to a high-for-long situation. The key takeaway here, as Madhavi Arora points out, is that bond investors probably shouldn't hold their breath waiting for relief. Bond bearishness is just a fancy way of saying investors are pessimistic. It looks like bond yields are going to stay high for a while. And remember, when yields go up, the price of bonds you already own tends to go down. So it could be a tough environment for a lot of bond portfolios. You know, one of the most interesting things about this policy is how it shows a clear pivot in strategy. It's less about using a sledgehammer like a big rate cut for everyone, and more about using a scalpel, making very specific targeted moves. And nowhere is that clearer than with small and medium businesses. And Sudipta Roy from L&T Finance hits the nail on the head. Doubling the amount of money a small business can borrow without putting up collateral, that is huge. For a small business owner, access to credit is everything. This is a direct lifeline, and it's another great example of the RBI using its other tools to support the economy. All right, the current strategy is pretty clear. So the big question now becomes, where do we go from here? Let's look at the key signals and, of course, the risks that are going to shape what the RBI does next. This is it. This is the million-dollar question for every single investor out there. We've had this whole period of rate cuts, what they call a monetary easing cycle. So, does this pause mean the party's over? Well, all the signs are pointing to a big, fat yes. So here's your cheat sheet for what to watch. First, you're going to hear the word hawkish a lot more. All that means is the RBI is now more focused on keeping inflation down than on juicing growth. Their focus is shifting from big rate cuts to just fine-tuning the amount of money in the system. But there are two huge wildcards: what happens with global politics and how rocky the world's financial markets get. Either of those could change everything. And this final thought from Rajani Sinha really drives the point home. The bar for another rate cut is now incredibly high. Basically, unless something goes seriously wrong with economic growth, the message is clear. The era of easy rate cuts is pretty much over. The playbook has changed. It's shifted from broad stimulus to targeted support. So the real question for all of us now is, how do we adapt our strategy to this new reality?